This is why you hire a family office, because they know these things. Okay. You're essentially getting a 5-to-1 benefit.
Correct.
It's so smart. It is so smart. Dude, you've brought investment strategies to me that I've never heard of before. How many people are just starting out or like, I want to avoid the 7 years of mistakes that Pace made? I did things the wrong way for 7 years. I didn't know any other way. Wait, what? Your Uncle Sam's going to take how much money? Let's start it out by who the hell is Ryan Cox and what does Ryan do? Ryan works for a company called Do Wealth, and you guys run a family office. What is a family office?
Typically, you hear multi-hundred millionaires or billionaires run family offices. And what they do is they open a company, they bring in a CPA, they bring in a bookkeeper, they bring in a CFO, all in-house. And they do everything from taxes to investments to their bookkeeping for all their businesses.
So instead of at some point, what I was doing before, a lot of investors do is they outsource to a CPA, they outsource to a bookkeeper, they outsource to like a fractional CFO, maybe like an investment advisor at like Merrill Lynch or whatever else.
Yep.
A family office is somebody, let's say that I'm Warren Buffett. Obviously Warren Buffett has his own internal team. And so that internal team is called a family office.
Yep. And their sheer focus is you.
So what is the setup I have with you and Do Wealth?
Yeah. So before you were with Do Wealth, you were really the center of the wheel, working with your CPA or had somebody working there, working with your bookkeeper, working with your insurance people. And so we took you out of the center of that wheel and we put ourselves there, making it more of a virtual family office where we're quarterbacking things like getting your insurances in place, getting your estate plan updated, make sure your tax returns are right and you're saving taxes where you can. So we just try to quarterback everything from estate planning to life insurance to commercial insurance to personal insurance, really everything.
Most of what you're doing for me is cleaning up things. Is that correct?
That's all we've done for you.
Amazing. I did things the wrong way for 7 years and I didn't know any other way. I joined masterminds and I started meeting people like Chris Crone. I think Chris Crone is another client of your guys's or people you've done business with. And Chris was like, you got to just hire a family office. But that's not the first person you meet in your journey. The first person you meet in your journey is a Craigslist search. The guy you meet at church that says he's a CPA or he's a bookkeeper or whatever it may be. And it's not until you get around people who are making a little bit more money that you upgrade your team. Then you upgrade your team and then you upgrade your income. And this cycle goes on probably a good 6 or 7 times until you finally run into a team that's like the team you need to go across the finish line, right? So like Steve Harward is a good person that's been on my team the last couple of years, has really accelerated our ability to do LLCs and some of these things because you don't create my LLCs. You go work with the people that are doing that.
You got it. Yep.
I did things the way I thought I needed to do them. I kind of parsed it out myself. It was all basically fractionalized. Nobody was communicating with each other at all. What you've done in the last 6 months is you've brought everybody in. You've brought Matt Sorensen involved, who's my business attorney, who, he's representing us on our business acquisitions. You brought in my CFO. You guys are talking to PCS. You are currently looking and helping me find a new CPA. What is the challenge with my existing CPA?
I think you've outgrown the velocity you are growing. You've outgrown him and he maybe just not comfortable with the amount of real estate and different businesses you're involved in.
Do you see that happen with a lot of your other clients that are worth $50 million, $100 million? They outgrow a lot of people frequently?
Yeah, typically they will, but I mean, the CPA is probably one of the keyest cogs in your family office to have. So we usually have a pretty good Rolodex of CPAs to replace in if they're not a good player.
Dude, you've brought investment strategies to me that I've never heard of before. Like, what was the one that you were talking about with the land, like donating land? What's that
you
called?
Don't even want to do it.
I know I don't want to, but maybe somebody on here wants to.
It's called a fee simple. It's an aggressive tax strategy, but nothing that's out of bounds as long as you have the right co-sponsor that's doing it correctly. And
so what exactly is it? What do I do?
Essentially, we join a partnership with a bunch of other people or a syndication, and we go and buy land that is rich in oil. We know there's oil under there. And instead of drilling for it, we decide, hey, we're going to donate it to charity. But the donation is not the amount of land that was purchased, whatever the amount was there. It's actually the discounted cash flow, like the fair market value of what the oil would be if we were to drill it.
It's so smart. It is so smart. You guys go find a swath of land, let's say in Texas. It's an acre, hypothetically. And you can buy the land for $100,000. But the value of the oil, market cost of the oil is $500,000. So essentially what you're getting like a $500,000 tax credit for the donation for only $100,000
charitable deduction instead of a tax credit.
Sorry, a charitable deduction. This is why you hire a family office, because they know these things. Okay,
tax credit is way better.
You're essentially getting a 5-to-1 benefit.
Correct.
So I spend $1 and I get 5 credits essentially towards taking off my taxable income.
Correct. And then we multiply that by whatever your tax rate is. And so we see if you're in the highest tax bracket, that's 37%. You're in a state, if we're in Arizona, that's 3. So it's 40 total. So 500 times 40 is 200,000. So we netted 100,000 from that transaction.
So I put 100 grand in, but I saved $200,000 in taxes.
Correct.
So it cost me. So, all right, cool. It's a good strategy. What was maybe in your mind, you're like, he's such a dumb. I don't know what your thought is.
I didn't say that.
But what is the reason why I don't like it?
Because Pace has one thing in mind, real estate, because it has depreciation benefits and it has income potential with appreciation on the back end.
So this was my argument. I said, look, because our community understands sub 2 and seller finance, a lot of times we're getting into real estate for really low money down. Like I'd say we're probably averaging like 8% down on these deals, right?
I'd say that's accurate,
so
yeah.
let's say I go buy a $500,000 piece of real estate. I'm 40 grand all into the deal, hypothetically. So for that $40,000, I get $500,000 worth of depreciation. And then I take that out 27.5. I get pretty similar benefits. But the thing I really like about it is that now I own the real estate, and over time, the tax benefits I received will also give me appreciation, pay down, blah, blah, blah. Because I have to donate that land. If I donate that land, guess what I don't have now? I don't have oil. I got a voice memo. So like 2 years ago, I was talking to this guy about buying a jet. Because, you go buy a jet, you get 100% of the depreciation last year. I know it's not like that now. So if I bought a $5 million jet, I could wipe out $5 million of wholesale income, right? Hypothetically, or Gator loan income, or transaction coordination income, whatever it is. The problem I never really liked about a jet was if I buy the jet, guess what I now have? I have a liability.
And you have a depreciating asset that just costs a lot of money.
So I get a voice memo from this guy that I'm talking to about buying a jet 2 years ago. And he goes, hey, I've got this really cool thing. I go, tell me about it. Is it another plane that I'm going to have to spend 60 grand a month maintaining? I don't think so. I'm out. He goes, no, it's actually a really great idea. We're buying decommissioned planes, essentially, and we're taking the full depreciation off this plane that's maybe worth $2 million, but then we're parting it out. We're selling all the parts and we're getting $3 million back. So you're getting your depreciation, but then you're selling off the individual parts. So you don't have a recapture.
Yeah, but what about the plane, Ryan, is causing them to get the depreciation in the first place? It's just like
so they'll use it for business, and typically you buy it in October, November. You use it, you fly it a couple of times that year for business only, no pleasure, and then we're able to use that as an active piece of business, right? And then the next year is we can charter it out as passive, but the year we want the depreciation, it's an active business, just like Top Tier Transaction, all the other ones that you have.
Right.
So you're chartering it.
You're chartering it the second year, not the first
How
year.
do you make money on the first year?
You don't. They wait until like October to buy the plane, because now they go, okay, I'm going to fly it 2 or 3 times for business. I'm going to spend money. I'm going to use it for business. And now, because I used it for business, I have the ability to use it as depreciation. So like Steve Harward, for example.
Yes.
Steve Harward bought his plane. I think he paid somewhere around $3 million for his plane. So that first year in 2022, he got a full $3 million write-off. The problem is now next year, you've got to charter it so that now your payment, your pilot cost, your flight, all the things are covered by renting it out like Airbnb of the skies, right? Nobody makes money on doing charters.
I've yet to see it.
And every time somebody comes to me and says a plane is going to make you money, I'm like, show me 2 years. I'm going to send this to my family office. Ryan's going to look at this. And if you don't have at least 2 years of financials, he's going to laugh. And the guy goes, we don't have 2 years of financials. I'm like, then stop hitting me up.
Sounds pretty sketch.
It's an aggressive one. I mean, we have CPAs that are more than comfortable with it, but the normal chartering and that one that Steve did is totally fine. The one that you did, I don't know about, or the one that you pitched.
You'll look at it though.
I would look at it and question him, and he would probably stop talking to me.
I love it. That's perfect. You guys look at my partnership agreements. You guys look at, okay, well, Molly and I are partners on some things. You guys make sure those things are straight. You guys look at my arrangements with my whole corporate structure, which we will get into a little bit later. You guys protect me from another perception of going, okay, I don't like this. I don't like the way this is handling. One thing that I was obsessed with, especially when I started making money, was wait, what? Your Uncle Sam's going to take how much money? This is ridiculous. And then I wish I just started the right way. How many people are just starting out are like, I want to avoid the 7 years of mistakes that Pace made. And the fact that even 7 years later, Ryan is still cleaning up my messes from 7 years ago. If anybody ever asks you, why is Pace doing the corporate structure series? The answer is to help you avoid as many of the mistakes that I made.
And there are a few.
There are a few. That's a very light way of saying it.